The FBAR, which is an acronym for Foreign Bank and Other Account Reporting, Form 114, in 2013 actually used to be called the TDF 9022.1 and was governed by the IRS. Now it's governed by FinCEN, a division of U.S. Treasury. Requires that we analyze the individual non-U.S. accounts of an individual taxpayer, our clients, to determine if they have a filing requirement. I'm always hesitant to discuss the threshold requirements because I think they are subject to so much miscommunication and misunderstanding. But I will say this, that if an individual has an FBAR filing requirement, they must report every single non-U.S. account they have. And failure to do so, non-willful violation penalties, start at $10,000 per Form 114 per year. And actually, February 28th of 23, under the Bittner decision in the Supreme Court, that penalty used to be per account per year. And the Supreme Court decision rendered that the penalty should only be per form per year. Now, the willful violation penalty is the greater of, it could be criminal prosecution, but 50% the value of the accounts or $100,000. For those that are willfully not filing their FBARs, please be careful. Not a great idea. The Form 8938, the FATCA Form, another acronym that stands for the Foreign Account Tax Compliance Act. Form 8938 is actually called the Statement of Specified Foreign Financial Assets. So whereas the FBAR talks about foreign accounts, the FATCA Form 8938 talks about specified foreign financial assets. So what is a specified foreign financial asset? Well, in part, it is FBARs, it is foreign accounts. But it would also be foreign financial assets, so foreign being non-US, financial assets being commodities or derivative instruments or equities or debentures or swap arrangements and agreements. In addition, of course, to those FBARs, so financial assets that are not held in FBARs, in addition to the ownership of foreign entities, so foreign partnerships, foreign corporations, of any holding. So in essence, truthfully, the Form 114 and the Form 8938 FATCA filing are, in essence, duplicative. But yet, the Form 8938 gets filed with the tax return, and the Form 114, the FBAR, gets filed separately with FinCEN every year. So there's tremendous overlap between the two. But another big difference is that the FBAR has a very low filing threshold requirement, whereas the FATCA Form 8938 has a very much higher filing threshold requirement. So what we find with most foreign nationals in the US and most expats overseas is that they all have FBAR filing requirements, but maybe 50% of them have a FATCA Form 8938 filing requirement, because again, those thresholds for filing are so much higher. So we will determine the requirements in our offices. Why is that? Most people don't understand that if the penalties, which by the way are the same for the FATCA Form 8938 as they are for the FBAR, if they're assessed and that taxpayer has what we call reasonable cause, they can get out of the penalty. So what is reasonable cause? Reliance on a tax professional, CPA. So we undertake with all of our clients to actually do the work here in our offices. We don't want the clients doing the work, really for two reasons. One is that reasonable cause, getting them out of the penalty. The fact that we did the work, maybe we made the error, errors always happen, and therefore we can get the client out of the penalty. But more importantly, we're also using those determinations, which are more important, I think, at the FATCA filing level because of the much higher thresholds, to determine if that client has either filing. So if we rely on the work of the client and the client makes a mistake, not only are they going to be subject to a penalty that is not revocable, but also we're relying on errors to determine whether these forms have to be filed, which is never a good idea.